All right, welcome to Talkin' Investing. I am Tom, and as always, this is not financial advice. Today, I want to talk to you about 3 EV companies. They are small cap, high growth companies. We cover the small cap, high growth stocks a lot on this channel, particularly EVs, also Bitcoin miners. So if you're interested in that kind of content, please subscribe to the channel and hit the notification bell. And also, if everybody please smash the like button, it helps the channel out a lot, and I appreciate it. Lastly, there is a link in the pinned comment to our free Discord. So come on and join us over there and join the conversation. Okay, I want to talk about 3 EV stocks that have one thing in common, and this is an extremely unusual situation. All 3 of these stocks are valued at less than 0. So I'm going to go through and I'm going to show you what I mean by that, and I'm talking about their enterprise value. So for all 3 of these stocks, their market cap is worth less than the net cash that they have in the bank, which essentially means when you buy a share of their stock, you're buying cash at a discount. This is very rare. It does happen. There's some times where it makes sense that it happens. So I think they belong on people's watch lists, and I do own one of these 3. This is not financial advice. I'm not telling you to buy these stocks or sell these stocks. I'm just letting you know this is a very unique situation, and I want to go through it because I don't really think I've seen this before in my trading career. The first one I want to take a look at is a company called Electromechanica, stock ticker SOLO, S-O-L-O. So you'll see here their market cap is $161 million. They're trading at $1.37. Okay, so I'm just going to take a shortcut so we don't have to go through the financials and have a 1-hour video. So I'm going to use Yahoo Finance. You'll see these numbers are a little bit off, but all 3 of these do have negative values. So I want to show you how I'm determining that. So first we'll look at market cap. This says 153 million. We know that as of today's trading, it's actually 161 million, so that's a little bit out of date. This is what I'm looking at. Enterprise value. See this negative? This company is being valued at negative $38 million. And what does that mean? So if you look at their most recent financial statements, you'll see they have $194 million of cash. They have $3 million of debt. So their net cash position, were they to pay all their debt off, is $191 million. This stock is trading at a market cap of $161 million. So that means if you take the cash out of this equation, the market is valuing this company in total at negative $30 million. That means they think it's not only worthless, it's worth a negative amount of money. You will not find many negative enterprise value companies in the stock market. There are a handful right now. I think there's more right now than there's ever been. So do me a favor, if anybody knows any other companies other than the ones that I'm going through that have a negative enterprise value, drop it in the comments below. And if I find one, I will dig into it and potentially do a video on that, because these are oftentimes interesting stocks. Now, there are reasons why a stock would have a negative value, which is why this does rarely happen. However, these 3 I'm going through don't really fall in that situation as far as I'm concerned. So if you look, I'm going to look at one more thing. This is cash flow statement. So on their most recent cash flow statement, last year they burned through $71 million in cash. So they have $194 million in the bank. At that rate of cash burn, that's over a 2-year cash runway. So with a 2+ year cash runway, this company is valued at a negative amount. So typically where you would see a company valued at a negative enterprise value is if they had a 3-month cash runway or a 6-month cash runway, which means they're imminently running out of cash and they're in imminent danger of going bankrupt. This company does not fall into that. They have at least, it looks like, at least a couple of years to get to where they're going, but clearly the market does not believe that they are going to get there. So if we look at this company, in the case of SOLO, there are 3 analysts covering revenue for 2022 and 2 analysts covering revenue for 2023. So you'll see right now, the analysts believe there's going to be 400% growth this year in 2022 and almost 900% growth next year. So obviously this becomes a due diligence situation. If this company is going to do this, they're predicting net income at a similar pace, so we can predict net cash burn at a similar pace. This is beyond an ultra high growth company if they can hit these levels. So again, I have no idea if they're going to hit these levels. Last year they did $2 million, so this is a very early revenue stage company. They have a very unique product, and we're going to see if the market wants it or if they don't want it. But in the meantime, it is clear the investment community has priced in failure for this company. And if we look at the chart, you're going to see that from their high, which was over a year and a half ago now, if we go down to where they're trading today, this company's down 90% off of their highs from just a little over a year and a half ago. But if I do this the other way, even if we were to go back 3 months, if SOLO could get back to its price that it was trading at just 3 months ago, that would be almost an 85% increase in the stock price of SOLO. So to me, this is why these are very interesting, because again, at its current price, it is being priced as a negative amount of value in the company itself. So I do think with these types of companies, we are in an absolute risk-off environment. And I think that's why we find ourselves in this situation where I'm able to find a few of these. So lastly, if this company was to get back to where it was trading about 7 months ago in November, that would be over a 200% increase in the price of their stock. Now, if they have sales growth at the rate that they're predicted to have it, I imagine this is a fairly realistic price target. Again, this is not financial advice. I don't know what Solo is going to do going forward as far as sales go and net income goes, but I do think this represents a very interesting opportunity that I have on my watch list. I don't own this stock, but it's on my watch list, and I think it's worth watching. Let's go to the next stock. Okay, so the next stock is a company called AYRO, stock ticker AYRO. So if you want a deeper dive on AYRO, you can look right here. I have done a deep dive video on this, but for now, let's stick to the top side here. This company's market cap is now down to $34.6 million. So you can see the enterprise value is negative $29 million. So again, if we look at that, what that means is this company has $63 million in cash. They have $1 million in debt. That is $62 million. This company's market cap is $34 million. So they literally have almost twice as much cash in the bank as the entire value of the company. So this company is being massively negatively valued. This is over a 40% discount on the cash in the bank, which essentially means you could buy $1 for 60 cents. Now, if you believe they're going out of business and they're going to spend through all their money, then obviously it's not worth it. However, this is why I'm saying do your due diligence on these and take a look, because in my mind, some of these do represent very good risk-reward scenarios. Again, this is not financial advice. You guys have to decide your own risk tolerance, time frame, etc. But you can see here again, their operating cash flow from last year was negative $28 million. So they have a 2+ year cash runway, even if they continue to burn cash at that rate. So this is another company with a multi-year cash runway that is being valued at significantly less than the amount of net cash they have in the bank. So taking a quick look at the chart on this one from February of 2021, so again, just a little under a year and a half ago, this stock is down about 92%. So all of these stocks have been beaten down significantly. This does limit their ability to raise capital via equity. However, that's why I'm looking at their cash runways. If they have a multiple year cash runway, then their company could be in a very different position 2 years from now, and the market could be in a very different position 2 years from now. This is one of the most risk-off markets in the history of the stock market. It's definitely the most risk-off since I've been trading stocks. So again, both this company and the market have a few years to get in a better place. This is not a recommendation. This is not financial advice. You have to decide whether or not this is a risk reward that is worth it for you, but I do own this stock. Okay, the third stock is a company called XL Fleet, stock ticker XL. So here we have a market cap of $193 million. You're going to see this is a little out of date as usual. So $193 million, that leaves them an enterprise value of negative $145 million. I mean, that is a massive negative value. So how do they come up with that? If we go down and look again, you're going to see total cash, $333 million, total debt, $4 million. So their net cash is approximately $329 million. You'll notice all three of these companies have something in common. They have a nice amount of cash in the bank, and they have very little, almost zero debt on their books. That's a good situation to be in financially. And here's a company where their operating cash flow last year was negative $57 million. If they were to continue along at that rate, this company has the longest cash runway of them all, potentially maybe 5 or more years of a cash runway. So this company has an awfully long time to get where they're going. Yet the market is valuing them at negative $145 million. So this is another company that would very nearly have to double just to get back to a zero enterprise value. And again, you're going to be hard pressed. What I would recommend everybody do is go pick 2 or 3 of the stocks that you are scared of and you're staying away from, that you think are the worst stocks in the stock market, and take a look at their enterprise value. And my guess is they are going to have a positive enterprise value. Having a negative enterprise value is extremely rare. So when you think about the fact that the worst stock you can think of doesn't even fall into this category, that is why I think these are worth having on your watch list, and that is why these are very interesting to me. Okay, so if we look at the chart, XL Fleet is down almost 96% from its highs just over a year and a half ago. So all of these companies peaked about 18 to 20 months ago, and they've been downward accelerating ever since. So this company's down 96%, so they are not likely to raise cash through equity anytime soon. But like we said, it looks like they do have potentially maybe a 5-year cash runway. So while I don't own this one, one. This is definitely on my watch list. Okay, so those are my 3 stocks, again, in the electric vehicle industry that are all priced at a negative value, meaning their market cap is less than their net cash. So I do have other companies in other industries that are also marked at a negative value right now. This is a very rare thing. So I will go through some more of those over time. And again, if you guys know of any, please drop in the comments any company that you know that's trading at a net negative enterprise value. Also, if you made it this far, please remember to subscribe to the channel and smash the like button. Thanks so much for watching, and we'll see you in the next video.